Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to have someone from the San Francisco Bay Area after a while. His name is Aaron Rubin. So as an attorney, a CPA, and a certified financial planner, Aaron runs a wealth management practice that integrates tax, financial planning, and investing. So this is something I love. I always talk about whenever you are investing, you got to think about tax liabilities. You always want to make sure that your investment aligns with your goals, as well you keep most of what you make. So this is going to be an interesting episode because he is located in the Silicon Valley. He works with a lot of pre-IPO executives and early employees at late startup tech companies. So welcome, Aaron.
Yeah, great to be here.
Absolutely. So the first question we start with is, tell us something interesting or funny about yourself.
Yeah, so interesting. I'll go with interesting. So I was I did track and field in college. I was a Division III school.
Nice.
So again, no scholarships for me.
Right.
But I'll tell you so at one point, I was ranked second in the country for hammer throw, which is an event so that you can watch in the Olympics too. But I was nowhere near Olympic quality. But yeah, it was a fun time.
So do you still throw hammer?
No, I do. Well, I tell you, it's hammer when you're throwing it right, should go a couple, well, I never got a couple hundred feet. I got to 187 feet.
Pretty close.
So it goes pretty far out there. So and a lot of places don't want you putting enormous divots into their grass.
Right.
So no, I do not. And although I will say this, so I also did discus and shot put.
Okay. Yeah. So pretty similar. And now I have heard that a lot of people, there is this axe throwing thing going on. You can just go practice, right?
Yeah, well, axe throwing, you need a lot less room. I did do axe throwing before it was like super cool. So when I was a kid, one of my friends brought me to like their Boy Scout troop,
Yes.
just to hang out, and so we did axe throwing at the Boy Scout troop, and I was like 12, but it was super fun.
Yeah. No, that's where I went to Boy Scout with my daughters as well, because now they're part of it. And we were able to do the BB gun and archery.
Yeah.
And I think the next camp we'll be able to do axe throwing.
There you go.
It'll be fun.
Yeah.
So let's talk about the investment side, right?
Sure.
And personally, what kind of assets do you invest in?
So a lot of it depends. So we focus mainly on marketable securities, so things that can be sold readily. And so depending on the type of account that we're looking at, that sort of dictates what instruments we tend to use. So for people that have, IRA 401k type money, we tend to use mutual funds, sometimes ETFs, depending on what we're trying to do. But when we look at accounts where, you pay capital gains tax, and accounts where you pay dividends or tax on the dividends, we will often use individual stocks to try to get the best tax result that we can, along with getting the good investment result.
Right.
So again, there's everything requires its own analysis.
Right. So personally, do you only invest in stocks, or do you invest in other alternative assets?
So I guess it depends on how you define alternative assets.
Anything other than Wall Street is alternative.
Anything else than Wall Street?
Well, it could be real estate, gold, cryptos.
Yeah. Okay. Yeah. No, I will tell you, I'm not a crypto investor. That's not my thing. I have opinions on it, but again, I don't recommend that for my clients. I do have a couple $100 in crypto just because I had enough clients ask me about it that I always like to get my hands dirty and like
Right.
and really get into it to understand it. So I do I do have minimal amounts in crypto, and I'm not an active trader at all. You know, I have a couple rental properties you know, in Texas, and you know, so far so good on those.
Yeah.
You know, and you know, for clients that I do have clients that come to me and say, hey, you know, we put a lot in the market, and I'm really happy with it, but you know, what do you think about real estate? So we talk a lot about real estate, and of course, when you're in the Bay Area,
Yes.
I mean, everyone talks about real estate all the dang
Yep.
time. So you know,
Yep.
you have to really sort of you know, understand it as much as you can, and you know, understand the benefits and the drawbacks and all that, and be able to advise on it. You know, we also do, you know, in some accounts we'll do uh, uh, direct lending, you know, using, you know, partnership structures, you know, for middle market use. But aside from that, you know, we don't really do anything, I'll say, too far off the beaten path.
That's awesome. Yeah, so I'm exactly opposite. I don't do stocks pretty much. I used
Sure.
to do options and futures
Oof.
7 years ago.
Okay.
So I have done it all, and then I realized it's not for me. I don't want to, you know, because I was not seeing ROT, return on my time. So I moved into alternative investments, and real estate is, of course, my biggest portfolio, you know, part of my portfolio. So this would be interesting because I of course want to know what's going on in the other side.
Yeah. Oh, me too. No, I'm kidding. No, we, yeah, it's an interesting time, to be in the stock market and the real estate
And
market at
everywhere,
this point. So
everywhere thing has been frothy. So this would be fun episode.
yeah, frothy. I love the name frothy. I love the word frothy. It's great. I'm going to use that. I'm stealing it.
Uh, so let's talk about tax side, right? And
Sure.
you and I have been were chatting earlier. What is the, because you focus on, of course, investment and the returns, but you always want to make sure that the tax liabilities are covered, or at least you find loopholes, the legal loopholes, so that we don't have to pay a lot of taxes. What is the worst tax mistake you have seen?
Yeah. So the worst mistake that I tend to see, and it sometimes repeats itself with people, is when they have their stock options, um, they they don't know the tax liability that's behind those options necessarily. And I say that because there's several different types of options out there, and some are easier to deal with than others. So you know, if you have what's called an incentive stock option, you know, what happens is, you know, you have a strike price, what you're going to buy it for. You have a fair
Right.
market value, and that, if it's a pre-IPO company, there's a valuation that's done, you know, at least annually. You take the difference between those two, and the difference is going to give you what's called your bargain element. And the bargain element essentially is a paper gain, right? It's the value you get by purchasing the stock. You're purchasing it for a lower price than what it's worth. And so for incentive stock options, what happens is that paper gain doesn't show up on page 1 or 2 of your tax return. It actually shows up on a completely different form that you probably aren't well aware of, called the alternative minimum tax. And so with the alternative minimum tax, you know, it's a different calculation, and that paper gain, which is not taxed on normally, um, is taxed for AMT purposes. And again, I'm happy to jump into AMT and as much as you
Yeah.
want to. But needless to say, it's a pitfall out there that some people just don't recognize, that they haven't heard about, they haven't done the research, or they're not working with a tax advisor to warn them about that sort of thing. But you know, I've seen people, they've run themselves up hundreds of thousands, occasionally, I mean, millions of liability, on the purchase of stock that they didn't know about. And if you're in a pre-IPO situation, and you generally can't sell, that could really hurt, because the
Yes.
IRS does not care that you do
Right.
not have the money. They want it. They want what you
Yeah.
don't have. So again, that's something that I see that comes up from time to time.
So how do you mitigate that kind of situation?
You know, you need to do some planning. You
Okay.
know, it comes down to that. And then you need to find your alternatives. Once before you get yourself into trouble. So
Right.
you go out, so if you come to our firm, right? We have a CPA firm in addition to the wealth firm. So we do a lot of CPA work. So you come to our firm and you say, hey, could be hundreds of thousands of shares of XYZ stock. And by the way, and the gain per share is, $10. Okay. Well, maybe you're looking at a couple $1 million of additional income on your AMT, which is going to cost you, it's about 28%. So 28% of 2 million is what, 560 ish. So it's going to cost you, let's say it costs you 560 of tax. So now you have decisions to make. You can say, okay, there's lenders out there. There's always money, right?
Right.
Someone's willing to lend you
Yep.
the money. The question is, how much is that money going to cost?
Yeah.
And there's lenders out there who are willing to do that. The other way to approach it is you eat the elephant slowly, and you say, okay, well, I'm not going to incur a $560,000 liability this year. Tell you what, how many shares can I exercise and it cost me zero tax? The answer might be, out of the 200,000 shares, maybe it's 10,000 shares. So again, it's that slow burn, but again, you have to make that choice. And the way you avoid the liability is you plan.
Yeah. And I totally agree with this, right? And don't come to you or me after December 31st has passed, right? And I see this all the time. Just recently, I think it was in March, that one of my friend told me, oh, he wants to invest in real estate in some of my deals, but he wants to make sure he can write off. I said, yeah, you'll get depreciation benefits. He's like, can I go back last year? Because I just found out that I'll have to pay like 250 grand worth of taxes. I'm like, how do you not know? He said, yeah, I sold some stocks which I had owned for 20 some years, and I didn't realize that it would be that much of the tax liability. I'm like, there is nothing. No one has a time machine. You can go to anyone, but none of us can go back in time, not before December 31st, and plan it out for you. So it's important.
And sometimes there are things you can do and sometimes there aren't, but they're limited.
Yes.
Whether it's, if you have a Schedule C, you can, put money into a SEP IRA later.
Yes.
Again, you can now start 401ks after. Or defined benefit plans, or do also, there's some things you can do, but
yeah. So I mentioned to him about the 401k, and the other was the investing in the opportunity zone real estate fund, right? But even then he had passed 180 days. But yeah, some of the things. So let's talk about the tax secret. What is the one tax secret you wish people knew about? One thing.
Yeah, I wish people knew about the 83B election. And we actually spend a lot of time on our blog talking about 83B. And what 83B does, it allows a taxpayer to elect to be taxed early on an asset. And there's reasons why you do that, because you think the asset's going to be worth more later.
Right.
And so, if you can make an 83B election on stock options, if you early exercise your stock options, let's say they're going to cost you 10 cents a piece to exercise, you got 100,000 shares, so that you got to come up with $10,000 to pay to actually buy the options before they vest, but you hand your company a check for $10,000. Within 30 days, you send an 83B election to the IRS and you say, hey, I just did this. I want you to tax me on the bargain element. Remember, we talked about the bargain element, the difference between what you pay and what the fair market value is today. And I don't want you to tax me on it when it vests. So now if you do it early enough, the difference, the 10 cents you pay today is almost certainly worth, the stock's almost worth almost always 10 cents. So that bargain element, at least in the beginning, is zero. So the IRS is going to tax you on zero, and you don't pay the tax later on. And so again, I wish more people knew about that.
No, that's a great strategy. And of course, as I told you, I'm not W-2. I don't look at pre-IPO, but this is so important because this is not similar to kicking the can down the road by putting money in 401k or IRA because you got to pay tax at some point. But in this case, you have already paid the tax. So more like Roth IRA, right? Now you're
Yeah.
just keeping the gains.
Yeah. Well, it's unfortunately not that simple, but because what happens is, if you don't early exercise, that tax liability grows.
Right.
And then when you want to exercise it, you get taxed on exercise.
Mm-hmm.
You will get taxed on sale.
Yes, the vesting price, right? When it
right.
gets
So
vested.
right. So but when you sell it, your 10 cents is your basis on that stock from here on out until you sell it. So if you sell it for $100 a share, you're still going to gain $99.90. But at that point, there may be strategies down the road that you can try to implement that'll hopefully lower that tax.
Got it. What is the best investment decision you have seen?
That I've seen, the best investment decision has been the people that I talk with at Coinbase. So I spoke with a lot of people at Coinbase before it went public. And every person that I spoke to at Coinbase said to me, no one exercised their shares, by the way, because no one thought Coinbase was ever going to go public. Right. So all the employees there, they were all sitting on unvested stock. Right. Because they didn't believe that the company was ever really going to happen. Anyway, so they all said to me, okay, I haven't exercised a thing. And we talked about, if you exercise and you hold for a year, you get the capital gains tax as opposed to regular income. And they said, that's great. I don't want my fate tied to the crypto market. And so the people at Coinbase, a lot of the people who were engineers or had been there for a while, as soon as the company was public and they could trade, they traded. And they lost a bunch of money to tax, but it was still the right decision.
Yeah. It's from 300 to $50 now.
Yeah. So, it's it's hard to make to do that because you hate giving up money to tax. Sometimes it makes sense to pay tax.
Yes.
So again, that's a hard call. So, and anyway, everyone at Coinbase who did that, kudos to you. Great choice.
That's great. And what is the worst investment decision you have seen?
So the worst is so when I was young advisor, I'm now an old dog. But when I was first in the industry, this is probably 10 years ago, maybe even more than that. I got a call from this woman, and she said to me, hey, I need to talk to you. This is 2012, 2011 at this point. Yeah, something like that. And she said, hey, my husband is convinced. So I don't know. And again, for those of your listeners who are old enough to remember 2008,
yes.
Everyone was really, really anxious about the next 3 or 4 years after 2008, because everyone was predicting, oh, there's going to be a double dip. Oh, the double dip's coming, because they thought, okay, Great Depression, right? If you look at the Great Depression, what happened was the market really tanked one year. It sort of popped back up and then it went right back down for several years. It was a huge deal. And so people all over the place, all over the news were calling double dip. So this woman's husband had convinced himself that the double dip was coming. And so as a result, he went out and he was buying triple bear ETFs. Which basically returns 3x the opposite of the market, right? Shorting the market times 3 leverage, right? That's a leverage position. So, and by the way, for your listeners, triple bear ETFs or triple bear type stuff like that, that is not meant to bet against the market. That is a day trader's tool. Right. So because essentially what it is, it's day traders ensuring that if just the total market tanks, they're not going to be completely screwed. So that's all that is. So if you want to short the market, do not use triple bear ETFs. It's not what they're for. Anyway, aside. So this woman said, hey, yeah, he's convinced of this whole thing is going to tank, and he of our life savings, he's already lost over $600,000. And and they didn't have 20 million. Right. They had a couple $1 million, and he had lost 30, 40% of their life savings. And I said, okay. I said, no problem. Gosh, I'm really sorry to hear that. I said, we can help you design a portfolio that, you can dollar cost average in. I mean, there's things you can do to try to, ease in a little bit, and we'll use mutual funds to do it. Because the mutual funds made sense for them. And she said, oh, you're going to use mutual funds? I'm not going to do it. She hung up the phone. and I always wondered what happened to that lady and her husband, because that was actually 2012. It was 2012. That was 2012. And so we all know what happened in 2013, which was the market went crazy.
Exactly.
And so, this guy could have lost even more, because remember, triple bear ETFs are not betting against the market. It's not the right tool. So he could have lost like everything. So that was the worst decision.
Wow. So let's talk about this, though, because you mentioned pre-IPO a lot, right? So when should someone at a pre-IPO company contact an advisor?
So I think on the tax side, if you're thinking about exercising shares in any kind of quantity, and more than, a couple $1,000s worth, and net worth of shares, not necessarily strike price, but whatever the value of the company is. If you're more than a few $1,000s into that decision, you should talk to a tax preparer, a professional who specializes in this stuff. And there's a few, in the Bay Area. And again, I like the work we do. But there's lots of other people out there that, again, you want to get with someone who knows what they're doing. We get a lot of people who are using tax preparers who aren't as familiar with stock options and some of the complexity around them. If you start, again, doing the calculation isn't too terrible, but understanding what to do once the calculation happens and your different choices thereafter, then it becomes a little more complicated. So, I'd say if you're exercising more than, a nominal amount of shares, go see a tax person, do the tax planning, spend the, for us, if we're doing a limited engagement, we're charging $350 an hour, and usually engagement takes, 2 to 5 hours. Pay the $1,500 bucks, pay the $1,500 and maybe you don't get the answer you want, but you're going to get the right answer. And that's more important. If it's a wealth, and if you're looking for help on the wealth side, I'd say it sort of depends on your situation. If you're high up if you're like a founder, or higher up, executive, you probably want to see if you can hook up with someone earlier rather than later, because they may have strategies for you. I mean, I talked with a guy the other day who didn't end up becoming a client of mine, but his advisor is actually doing a really good job. I mean, to be honest, he was a founder of a large company, and basically his advisor hooked him up with the right estate planning tools, and they did everything the right way. And I'm telling you, the guy that I talked to is going to save tens of millions of dollars by getting a good advisor. So again, it sort of depends. If you're an A-round company and you're not higher up in the organization, again, you might be able to wait on that a little bit. Certainly once you get to your D round of funding, C round of funding, talking with an advisor probably starts to make some more sense. So yeah, that's probably the higher up you are in the organization, the earlier you should really talk with someone.
I see.
I think by the time, the S1 comes around, which is the confidential filing for to IPO, by the time the S1 comes around, you're probably too late.
Yes.
So, so again, when you see that C or D round come around for you, go start talking to people.
Got it. So let's talk about the current market, right?
All right.
So, because we already have heard I word a lot, like inflation. Now we are talking about recession. Are we headed to or already in a recession right now?
Well, I'll tell you the Fed is doing its best to try to get us into a recession.
Yeah,
right.
And that's supposed to.
right. So, and that's what the market's reacting to. The market is reacting to Fed action. And the Fed's saying, yep, we're going to keep on increasing rates. We're going to make borrowing more expensive for businesses so they can't expand as quickly or they can't expand at all. So, and we want it all to really cool down. And so, I mean, if we're not in a recession yet, dang it, if the Fed's not going to do their best to make sure we are. What does that mean? Not, I mean, to me, it doesn't mean a whole lot. Whether or not you're in a recession or you're not in a recession, that doesn't dictate what the market's doing. The market's usually is a forerunner for things. The stock market has already has decreased by 30%. At least the NASDAQ at one point was down by 30%.
Yes.
So it's built in a lot already. Now, when the Fed comes out with unexpected news, then it's got to build all that stuff back in again. So again, it's the actual nuts and bolts of a recession, again, are not that important. The labor market is weird enough that, I mean, what you really worry about during a recession is people being laid off and not being able to afford to eat and to clothe themselves. That's not what's happening right now. This is a really weird time.
Yes.
And I think it has to do with, and now this is Aaron getting on his soapbox. It has to, a lot of, I think what we're seeing with the prices going up has to do with supply side issues.
Yes.
So there's still not enough cars. There's still not enough computers. There's still not enough of a lot of things.
Yes.
And then if Russia's going to start, messing with the food supply of the world, now that's going to push prices up. So it's being driven not by hot markets, although that was happening. It's being driven by not, right, because when you go, again, it's you go to any econ class, your freshman year of college, right? They teach you prices is supply and demand.
Yep. Always.
Demand hasn't, I don't think demand has changed all that much, but supply has. And that's what's pushing prices up higher, and the Fed reacting with, hey, all right, well, prices are up, therefore we're going to mess with demand. But they can't control supply. They can control, they can only control demand. So I think a lot of what we're going to see is, once hopefully supply chain issues figure themselves out, and I think that's going to be governed in large part by China's willingness to abandon its zero COVID policy, which is insane to me. But I think once they do that and they decide, okay, we're gonna push full tilt on our production, I think we'll see some relief on the pricing. And once prices start to fall, the Fed's going to have to back off its actions, or else it will be a serious recession.
Oh, that's awesome. Thank you, Aaron, for sharing a lot of information, interesting stuff today. Are you ready for fire round?
Fire round. All right, I'll take a fire round.
Would you be changing any business or investment strategy because of inflation or recession?
I would personally, again, I can't give investment advice to everyone over the, but I would say, depending on your situation, I always say that, again, I'm almost like a real estate investor in this way. When the prices are low, that's when you buy. Yes. And prices, I don't know if they're at their absolute bottom. They might not be, but they're lower than they were 8 months ago. So I'd say, if you see a recession and things really fall, buy it up.
Got it. Favorite finance or business book?
A fantastic book. It's called Financial Adulting. It's written by Aaron Rubin, and it has some good information in there.
Any tool or website you recommend?
So if it's pre-IPO, our website has tons of information for people who are looking to buy or sell pre-IPO shares, tax stuff and financial stuff.
Any advice for beginner investors?
Yes, read my book. No, so the so if you're starting investing, Warren Buffett said that investors, both institutional and individual, are almost always better off buying a low cost, well diversified mutual fund. And he's not wrong. So there's some great stuff out there, whether or not you use, tried and true companies like Vanguard, if they've got great suites of ETFs and mutual funds. Or if you are into sort of more momentum profitability tilts, Avantis has some great funds out there too.
How do you give back?
How do I give back? I used to spend a lot of time on my synagogue's committee for for the board. But I've got the 3 kids, and I've not been able to give back like I've wanted to. So it's unfortunately been mainly cash at this point.
Oh, that's good. That helps too. How can my listeners reach out to you?
So great number of ways. Obviously our website, www.wrpwealth.com. Great resources. Also, you can book an appointment if you want to talk with one of us, as well as you can find us on Facebook, and Twitter is WRP Advisory. And I just started a TikTok account not too long ago, so I'm excited about that. So
you can dance and sing, right?
Yeah, a lot of cat videos. No, I'm
Yes.
kidding. Or videos about corn, which apparently is now the thing. But we do every week. I try to do like a new graphic on IPOs, and so it's called IPO Graphs. So it's Twitter, not Twitter. Oh my gosh, it's I just blanked on the name. TikTok. I'm sorry. Too many T's. I was thinking Twitter.
Yes.
No. Tumblr. No. TikTok. No, it's TikTok. IPO Graphs. Check us out.
Thank you so much for your time today, Aaron.
Yeah, I know, it was great being here. Fun time.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!